Welcome to the Japan Stock Podcast. Whether you are a seasoned retail investor managing your own portfolio, or you're just someone fascinated by the sheer complexity of the global semiconductor supply chain, this deep dive is completely designed for you.
Absolutely. We've got a really fascinating one today.
We really do. Our mission today is to decode the heavy machinery sector without burying you in opaque financial jargon. We are looking at the source material for Shibaura Mechatronics stock code 6590.
All right.
And we're going to look at how a company escapes a dying industry, completely reinvents itself, and in doing so accidentally walks right into the crosshairs of global geopolitical warfare.
Yeah, I was just going through the stack of recent financial reports, analyst notes, and their 2025 to 2026 management projections he sent over. And honestly,
What's the verdict?
it feels less like reviewing a standard corporate balance sheet and much more like reading a biological survival thriller.
A survival thriller. I love that.
Yeah. I mean, in the corporate world, there is this ingrained expectation that a company's DNA is fixed. Like if you make heavy machinery for flat screen TVs, that is your genetic code.
Right, and when that market saturates, you just sort of fade away.
Exactly. You slowly fade into irrelevance. It is incredibly rare to see an established heavy machinery manufacturer actively rewrite its own operational DNA mid-flight just to survive.
But they actually pulled it off.
They did. And to truly grasp the magnitude of it, you have to look at the raw financial trajectory in these recent earnings reports. The transformation over the last few years is staggering.
Hit us with the numbers.
Okay, so if you go back to fiscal 2021, you see a company generating roughly 49.2 billion yen in sales.
Okay, pretty solid.
But fast forward to 2024 and they smashed through the 80.9 billion yen mark.
Wow, almost double.
Yeah. And this is crucial. Anyone can juice top-line revenue, right?
Yeah.
The real story here is their return on equity, or ROE.
The efficiency metric.
Exactly. It was sitting at a completely average, frankly unremarkable 9.5% back in 2020.
And
Today, they are sustaining an ROE well above 24%.
wait, 24% for a hardware manufacturer?
Yes, that is elite territory for a company that has to maintain heavy physical factories.
Okay, so let's unpack the mechanics of that transformation, because that is the hook for you as an investor listening to this. How did a company heavily reliant on making machines for flat panel displays like the LCD screens in your TVs and smartphones pivot to become a highly profitable hidden giant in the generative AI revolution?
Great question.
And the secondary question we have to answer, by succeeding so wildly in the AI space, are they now sitting dangerously exposed to macroeconomic crossfires?
Well, to answer the first part, the scars of their past are essentially the armor they're wearing today. Historically, Shibaura's revenue mix was massively tied to the flat panel display industry, the FPD market.
Which used to be great, right?
Oh, it was a decent business in the early 2010s, absolutely.
Yeah.
But it eventually became brutally cyclical.
Because of the subsidies.
Exactly. Chinese state subsidies flooded the panel manufacturing market, and it drove the cost of screens straight into the ground. Panel makers just stopped buying new equipment.
So price competition for the machinery basically became a race to the bottom?
A total race to the bottom. But looking at the trajectory in the analyst notes over the last 3 years, Shibaura was just ruthlessly unsentimental about abandoning their legacy.
They realized holding on to a commoditized market was a death sentence. The market for shiny new TV screens was saturating globally. So instead of fighting a losing price war, they essentially packed up their highly precise tools, walked across the street, and started selling picks and shovels to the generative AI gold rush.
That is exactly what the financial documents show. They completely inverted their revenue engine. Today, roughly 75 to 79% of their total revenue comes from semiconductor production equipment.
From basically nothing a few years ago.
Right, and we need to be very specific about what kind of semiconductor equipment, because they didn't just try to build everything,
Oh, right, the two divisions.
Yeah, they split their semiconductor business into two distinct divisions. First, there is fine mechatronics, which handles front-end wafer processes.
And the front end is basically the chemical and physical process of carving billions of microscopic transistors into a raw silicon wafer, right?
You got it. And then there is the Mechatronics Systems division, which handles back-end packaging.
Okay, let me visualize that for everyone listening. If the front end is the incredibly complex printing press that stamps the circuitry onto the silicon, the back end is taking that large printed sheet, slicing it up into individual chips, wiring them up, and sealing them inside those protective black plastic squares you actually see when you open up a computer.
That is a perfect metaphor.
Yeah.
And that separation is critical because to understand Shibaura's true identity beyond just a generic manufacturing equipment maker, you have to understand their operational philosophy.
Which is the global niche top strategy, right?
Yes, the G&T approach. I mean, in the semiconductor equipment world, you have massive broad-spectrum giants like Applied Materials or Tokyo Electron who provide end-to-end solutions.
They do everything.
Exactly. And Shibaura doesn't try to fight those behemoths head-on across the entire factory floor. Instead, they find a highly specific, insanely difficult bottleneck in the manufacturing process where the big players aren't heavily focused.
And they just dominate that single bottleneck.
Completely. Right now, their absolute core identity is being a global niche top enabler for advanced semiconductor packaging in the back end.
Which brings us directly to the data point in the 2025 financial reports that absolutely leaps off the page. I mean, I audibly gasped when I saw it.
The TSMC numbers.
Yes. When you trace their sales by customer, the numbers tied to Taiwan Semiconductor Manufacturing Company, TSMC, are just explosive.
Let's walk through the math. In 2023, sales to TSMC were about 7.9 billion yen.
Okay.
In 2024, that jumped to 18.3 billion yen. And by 2025, it reached 34.4 billion yen.
That is insane growth. So if total sales are hovering in the 80 billion yen range, a single Taiwanese foundry accounts for roughly 42% of their entire global revenue.
Yeah, 42%.
I mean, on a standard balance sheet, that level of single client concentration is usually a massive red flag.
Oh, it is a phenomenal concentration of risk. But to understand why a titan like TSMC is throwing so much capital at a relatively small Japanese equipment maker, we have to map out the physical causal chain happening inside the fabrication plants.
It's all about the AI chips, right?
Exactly. It traces back to the soaring global demand for generative AI GPUs. To make the ultra-powerful AI chips that tech companies are currently hoarding, you run into a hard wall of physics.
Because the chips have gotten physically too large to print in one go.
Precisely. It's an issue of reticle limits and yield rates. Look, if you try to print one massive, flawless AI chip on a piece of silicon, the probability of a microscopic defect ruining the entire expensive chip approaches 100%.
It becomes economically unviable.
Right. So the foundries changed their strategy. Instead of printing one giant chip, they print several smaller chiplets where the defect rates are much lower.
Oh, I see.
Then they stitch those smaller chiplets together side by side or stack them vertically on a silicon interposer so they act as one single massive brain. This is known as advanced 2.5D and 3D packaging.
And stitching those microscopic chiplets together requires a level of precision that defies imagination.
It really does.
Think of Shibaura's high-end wafer-level package bonders,
Right.
specifically the TFC 6500 and 6600 mentioned in the source material, like microscopic sewing machines.
That's a good way to look at it.
I mean, if you were stitching together a standard $10 t-shirt, you can use any basic sewing machine. If the needle slips, you throw the shirt away. But if you are stitching together a multi-million-dollar astronaut spacesuit, and a single missed thread means the suit depressurizes in orbit, you buy the absolute best machine on Earth, regardless of the price.
Exactly. Because those AI chiplets are so incredibly valuable, the foundries cannot afford a single alignment error in the final packaging phase. The cost of a ruined badge is catastrophic.
So that dynamic must give Shibaura immense pricing power.
Massive pricing power. Because they hold this global niche top position with incredibly high barriers to entry, they don't have to discount their machinery.
They aren't in a race to the bottom anymore.
No, not at all. When you compare them to a peer like Besi in Europe, who is pushing advanced hybrid bonding, Shibaura has managed to carve out a parallel stronghold in precision flip chip and wafer-level bonding without fighting on price.
And we can see this pricing power explicitly in the financial causal chain, right?
Oh, absolutely. Over the last 4 years, their gross margins have improved so drastically that their return on sales, their operating margin, expanded from a meager 6.6% in 2020 to around 17.5% today.
That flow-through is beautiful to see on an income statement. The operational success in the clean room drives the gross margin, which creates a massive expansion in earnings per share.
Exactly. And that EPS explosion is the direct causal driver pushing their ROE into that elite 24% range.
And it benefits the investors directly. I mean, they are generating so much excess free cash flow from these high-margin AI machines that management recently hiked their target dividend payout ratio to 35%.
Right, the picks and shovels are directly funding the dividend checks going into shareholders' accounts.
But, I mean, we can't ignore the structural vulnerability you pointed out earlier.
The 42%.
Yeah, having 42% of your revenue tied to one client in Taiwan is a staggering exposure. I look at that revenue pie chart, and it doesn't look like an economic moat. It looks like if TSMC catches a cold, Shibaura ends up in the ICU.
That's a very fair assessment.
Are they basically just a proxy stock for one massive Taiwanese foundry? I mean, what happens if TSMC decides to dual source their equipment to leverage better pricing? Does Shibaura's margin completely collapse?
Well, from a purely quantitative standpoint, yes, the revenue concentration is a severe risk. However, the qualitative data in the analyst notes tells a slightly different story regarding switching costs.
Okay, how so?
The switching costs in advanced packaging are astronomically high. You don't just swap out a bonder that is handling a multi-thousand-dollar GPU because a competitor offers a machine for a 10% discount.
It's too risky.
Exactly. In fact, the recent materials highlight that Shibaura won an excellent production support and advanced packaging award from a major customer.
Oh, wow. So they are deeply integrated.
Very deeply. It suggests the technology isn't just a vendor-client transaction. It is structurally embedded in the client's long-term manufacturing roadmap. They are co-developing the next generation of packaging.
Okay, so the technological moat is solid. They are effectively bolted to the floor of the most important fabrication plants on Earth.
Right.
But that massive 42% revenue share isn't just a financial metric. It dictates where Shibaura physically has to operate.
Geography.
Yes, when you map out their geographic footprint, that operational strength suddenly morphs into a massive geopolitical liability.
It really does. Let's break down that global footprint. According to the latest figures, Shibaura's overseas sales ratio has officially crossed the 80% mark.
80% outside of Japan.
Yeah. And as we established, Taiwan alone represents over 56% of that total overseas pie.
Meaning they're generating the bulk of their profits operating right in the middle of the most geopolitically sensitive, heavily militarized real estate on the planet.
That's the reality.
Any blockade, natural disaster, or kinetic event in the Taiwan Strait doesn't just hurt Shibaura, it basically zeroes out their primary revenue engine overnight.
It's an existential risk. And the second massive piece of that geographic puzzle is their exposure to China.
How big is that piece?
The Chinese market still represents a vital 23 to 30% of Shibaura's total business.
Okay, so between Taiwan and China, that's essentially their whole overseas business.
Almost, yeah. Now, it is important to note the nuance here. The demand in China isn't primarily for those cutting-edge AI chiplet bonders. The demand remains incredibly strong for legacy nodes, silicon wafer processing, and vital wafer cleaning equipment.
Just to clarify for you, listen, when we say legacy nodes, we are talking about older, larger generation semiconductor chips.
Right, the workhorses.
Yeah, these aren't the chips training artificial intelligence. These are the highly reliable chips that run your car's anti-lock brakes, your microwave, and broader IoT devices. It is a massive, high-volume cash cow for equipment makers.
It is a critical revenue stream.
Yeah.
But there's a preemptive warning tucked into the recent corporate observations that we have to talk about.
What happened?
After attending Semicon China, which is a massive semiconductor industry exhibition in Shanghai, management noted a distinct shift in the landscape.
Oh.
Chinese domestic competitors are rapidly gaining technical capability in advanced machinery fields. Driven by massive state incentives to localize their supply chains and replace foreign technology, these local players are learning and iterating at breakneck speed.
So the economic moat Shibaura enjoys on a global level is facing intense, localized erosion inside China.
Exactly. It's not just business as usual. It is a ticking clock. Shibaura has to constantly run faster in their R&D just to maintain their lead against local competitors who are heavily subsidized to dethrone them.
Which brings us to the macroeconomic catalyst that every investor is trying to price into semiconductor stocks right now, the United States regulatory environment.
The broader U.S. export controls, sometimes referred to as the Trump effect.
Let's do a numerical visualization of this geopolitical risk for our listeners. If the United States decides to tighten the screws on China's technological development via strict export bans or severe tariffs on tech equipment, how does a Japanese equipment maker headquartered in Yokohama actually take the hit?
It is a really complex mechanism, and we need to look strictly at the factual mechanics outlined in the supply chain data without getting tangled in the political rhetoric.
Just the numbers and the rules.
Right. Mechanically speaking, Shibaura's own machines do not inherently trigger U.S. export bans.
Oh, they don't.
No. The U.S. uses a regulatory mechanism called the Foreign Direct Product Rule, which relies on a de minimis threshold.
Okay.
Because Shibaura's machines contain a very low percentage of U.S. origin technology or intellectual property, their equipment generally falls under that threshold. So from a purely legal standpoint, their machines are perfectly compliant to ship to Chinese factories.
So they theoretically bypass the direct sanctions?
In theory, yes.
So I am looking at the systemic nature of fab plants, and there has to be a catch. I mean, they don't operate in a vacuum.
The catch is collateral damage, resulting in an indirect freeze.
What does that look like?
Well, imagine a sprawling Chinese semiconductor factory. They have ordered Shibaura's cleaning equipment and bonders, which are fully compliant and ready to ship.
Right.
But to run a functional production line, that factory requires roughly 50 different types of highly specialized tools. They desperately need extreme ultraviolet lithography machines, plasma etching machines, and metrology testing equipment.
And those other tools?
Much of that broader ecosystem is heavily reliant on restricted U.S. origin parts, or IP.
Oh, I see the bottleneck. It's like selling the world's most advanced high-margin ovens to a new restaurant opening in Beijing. Your ovens are perfectly legal to sell. You can put them on a cargo ship tomorrow.
Yeah.
But if the local municipality cuts off the restaurant's gas supply due to a separate zoning dispute, or the restaurant can't secure the permits to build a dining room well, they don't need your ovens anymore.
That's exactly it.
The restaurant halts construction. Even though your ovens are fully compliant, your massive profit margins simply vanish through absolutely no fault of your own because the broader ecosystem your client relies on has been frozen.
That analogy hits the exact mechanism of the risk. If the U.S. restricts critical node equipment, the Chinese fab cannot finish its production line. If the line can't operate, they aren't going to take delivery of Shibaura's equipment, regardless of its legal status.
Wow.
And diving deeper into the source material, there is another highly specific, often overlooked macro vulnerability tucked into their own upstream supply chain.
Wait, really? More supply chain issues?
Yeah, it isn't just about the geopolitical risks of selling the machines. It is about the raw materials required to build them in the first place.
Actually, I noticed this when looking at their manufacturing inputs. We talked earlier about the microscopic sub-micron precision required for those high-end bonders.
Right, the tiny chiplets.
Achieving that level of physical control means Shibaura relies heavily on linear motors to drive the robotic arms. My understanding of industrial linear motors is that they require incredibly powerful permanent magnets to function, which leads us straight back to a reliance on rare earth elements.
Bingo.
And that is a raw material market almost entirely processed and controlled by China.
You followed the causal chain perfectly. Geopolitical friction directly threatens this highly specific supply chain. If trade tensions escalate and export quotas are placed on rare earths, the flow of these critical magnetic components could slow to a trickle.
Which means they literally couldn't build the machines.
Exactly. For Shibaura, this immediately risks profit margin compression. They would face spiked input costs to secure alternative supplies, severe component shortages, and elongated delivery times.
That's terrifying for an investor.
Yeah, I mean, they literally might possess a massive backlog of orders for AI bonders, but be unable to build the machines fast enough to recognize the revenue before the fiscal quarter ends.
So for everyone listening, let me pull together a quick 80-20 summary of what we've uncovered to crystallize exactly what is driving the underlying value of this stock.
Go for it.
We are looking at a masterclass in operational pivoting, wrapped in a geopolitical straitjacket. Shibaura Mechatronics ruthlessly evolved its DNA. They saw the display panel market commoditizing, took their legacy of precision engineering, and successfully pivoted into advanced semiconductor packaging. By doing so, they engineered a high-margin cash machine perfectly positioned to supply the current generative AI boom.
That's a perfect summary. But that very financial success, the 24% ROE, and the high dividend yield is currently tethered to extreme geographic and client concentration.
The double-edged sword.
Right. Their biggest operational strengths,
Yeah.
the massive partnership with TSMC and the high volume cash flow from the Chinese legacy market, are simultaneously their most glaring vulnerabilities if the macro environment shifts.
Which leaves us analyzing how management plans to navigate this tightrope. Because looking at their strategic capital policies between 2023 and 2025, they aren't just sitting on their cash.
Not at all.
Shibaura is currently executing a massive 20 billion yen R&D investment plan.
And for a company generating 80 billion yen in annual sales, committing 20 billion to R&D over a 3-year window is a massive, aggressive war chest.
It's a huge bet.
And the documents reveal that a significant portion of this capital expenditure is funding a brand new, advanced research facility located in Yokohama.
And that brings us to the final provocative thought I want to leave you with today. We know their intense vulnerability to geopolitical shifts. We know their heavy reliance on a single Taiwanese client and the creeping threat of localized competitors in China.
Right.
So when you look at that 20 billion yen R&D war chest and that new Yokohama facility, are they using that capital to simply double down and deepen their current niche in advanced packaging?
It's possible.
Or, knowing their own history of radical adaptation, is this actually their emergency fund? Are the engineers in that Yokohama lab already quietly working to invent their next incredible survival pivot before the geopolitical winds change and the current market dries up?
It is the ultimate question for anyone analyzing their long-term valuation. I mean, a company that completely rewrote its corporate DNA to survive once certainly has the institutional memory to do it again.
Keep questioning the numbers behind the narratives. Thank you for joining us on this deep dive on the Japan Stock Podcast. We'll see you next time.